Hello, everyone, and welcome to our tactical portfolio update for the month of June 2024. A lot to cover this month. We had a rate cut by Bank of Canada. The tech stocks continue to rally through June, and everything is coming up power. We're going to be talking about electrical power and what that means for portfolios and opportunities. This is your tactical update, and let's jump into things. As always, I'm Michael LeBlanc, and remember, the information we provide on these videos are for information purposes only. Always do your own due diligence, or better yet, reach out to us for some professional review. We're happy to do a free portfolio evaluation, discuss your goals, give you a second opinion on kind of your current holdings and how they line up with your current goals and objectives. You can always reach us either through the links in the description down below, or you can go to mikeonmoney.com or llcprivatewealth.ca is our main site where you can get all our contact information as well. Stick around and I'll talk about some of the new exciting videos we have up and coming as well. All right, so let's dive into what's been happening in June. The portfolio's been doing quite well. At the end of May, we were up about 22% on a 12-month. Keeping up with the indexes. We'll talk a little bit more about the indexes when we talk about the tech companies. As always, I want to remind you about our all cap portfolio. The beginning of September, we should have its 1-year numbers, and we can start talking about how it's been performing. But it's been really interesting to watch that one. It's a bit torquier. It's got some of the bigger names in there, like Nvidia, which has of course been in the news a lot these days, and Adobe. So a few more higher performance names in that portfolio. But of course, with that comes a little bit of volatility. And once we can talk more about its performance and how it's done over the last 12 months, we'll give you a bit more description on where that's appropriate and where you want to have that as part of your investment diversification. Anyway, let's talk about the tactical portfolio. As I mentioned, the Bank of Canada has implemented a 25 basis point cut. So this has been, obviously everyone's been waiting for it. The market was highly anticipating it for a June cut. If you watch our previous videos, I've been saying I didn't think that they should do the June cut, and I still don't think. I must have been out of the office when they called to ask my opinion, but they did go through with it, which, was pretty lackluster accepted in the market. The market was kind of like, yeah, we want it. Probably would have been negative impact if they didn't get it. But overall, the market kind of just went, meh, not on the Canadian side. Anyway, a lot of the interest rate sensitive sectors that we've been watching to move on interest rate cuts, didn't really react. One main ones, the banks, which we'll talk about, utility companies, any of the dividend paying stocks, which tend to go up as interest rates go down. And pretty much the reasons for that is because it was a small one, and really what they're looking for is a trend for it to get lower and lower and lower. So we'll see. We still like those areas. In fact, the bank stocks, as you've been following, if you've been following us, you're looking at your portfolio. We have a covered call strategy on the Canadian banks and life insurance companies, the ticker symbol BANK. We actually did a deep dive video with the CEO of Evolve, the Evolve ETF, to kind of break down exactly what that position is and why it's a great opportunity. Of course, while we hold that position, which, as I mentioned, the bank stocks really didn't move too much on the interest rate cut move. They've had a little bit of volatility due to TDs had some bad news with the regulators down in the United States. But banks held in there nicely. And the good thing about that type of position, with the cover called and the dividend, it's currently yielded us on an annual basis just over 16%. So go look at that video. Again, you can go to our website or mikeonmoney.com and find it there, or our YouTube channel. We did a deep dive on how it works and how it's yielding that, and why we really like it as a position. So that's in there as well. Now, I mentioned the tech stocks continue to move in June. It's true. The Magnificent Seven, or the Mag Seven, as we like to call them. Your Nvidia, your Meta, Apple. Apple just had a recent run. A lot of people were saying it hadn't been contributing very much to this year. Google. If you have any of those stocks, they've done exceptionally well over the last 12 months. But the reality of it is the S&P. If you look at the S&P as an index, which a lot of people look at it as the main benchmark out there, the S&P 500 would actually be negative without the performance of the Mag 7. And a lot of that's been carried around this AI theme. We've got, I mentioned NVIDIA. Nvidia now becoming, the most valuable, the largest market cap company in the world right now. As I mentioned, Apple kind of having a big move after the recent announcement of implementing AI into their iOS, on the phones. Microsoft, of course, continuing to enjoy the AI revolution, and Apple and Microsoft both being in the tactical portfolio. We've seen some really good returns. One thing I'll say about the year-to-date numbers, which we'll have a lot more insight into that. In the beginning of July, we'll do a special mid-year video giving you a full breakdown of the performance. The performance in the portfolio so far has held up really well against the S&P, even though in our portfolio we're just around a 1% weighting of those Mag 7 stocks versus the S&P 500, which is just over 30% weighting in those Mag 7. So, a lot of the performance there is concentrated in those companies. And if we do see weakness, which we saw in April, we saw a big pullback in that index where the Mag 7 started to see some weakness. Our portfolio didn't have that. We didn't have that big pullback. We had a little bit of a dip in April, but not much, and fully recovered back in May because we're not relying so heavily just on those few names. And we still do have some exposures to some quality ones like Apple, Microsoft, and in, as I mentioned, Nvidia over in the all cap portfolio, being a bit more torquey, a bit more volatile with its valuation as we see that continue to run. And it just did a 10-for-1 split, so the stock was at 1200, went to 120. Of course, you get 10 shares for that, and then that's rallied up. The last time I looked, it was about $138 a share. So continues to run, but the valuation's getting pretty high there, mostly, as I mentioned, driven by companies out there buying up their chips. They don't do AIs themselves. Just want to be clear on that. NVIDIA's chips are used in the hardware for running the AI. Well, those data centers out there, those big, huge data centers out there that run the AI engines. So with that synopsis on technologies, let's talk about the other opportunity. Our latest position that we've put into the portfolio, Capital Power. Capital Power is out of Alberta. It's a electrical generation company. Sell most of their power to Alberta Power. About 80% of their output and about 20% is under contract to Ontario. So an electrical generation company. Why is this a great opportunity? Well, one, it's a good company. They're well capitalized. They've got great cash flow. The dividend yield's strong. All the reasons why we would like it and like it in the portfolio. Its valuation is cheap. As I mentioned in a lot of previous videos, the utility companies and the banks generally don't do well in rising interest rate markets, but in dropping interest rate markets where the cost of borrowing capital, the cost of operating goes down, they tend to do well. And also that strong dividend yields is very attractive to people when you can't get high returns or higher returns on your cash through interest rates. So we really like Capital Power for that reason, and other power companies. We also have a utility covered call strategy in the portfolio right now from BMO. Same idea as the bank. We're getting pretty high yields off of that, about 9%. But why do we like this? So let's talk about those data centers that everyone's talking about with AI. Now, remember, with data centers, these are just big, huge warehouses that have servers that can store data and process data. So anytime someone mentions, something's in the cloud, this is where it's stored. It's in these data centers. Anytime you talk about AI, where that's all processed, it's in these data centers. So these data centers are growing massively. The demand for them is growing, but the big problem is they need power. They need electricity, not only to run the servers themselves, which is a big power usage, but also cool because these servers run hot. So you got to keep these things cool. So all the companies around the world are looking for places to put these data centers, and they're trying to get them close to power and where they can have reliable power. So we really like Capital Power in that sense. They have a lot of land. They're in Alberta. There's a lot of land. There's a lot of attraction for these data centers to be located somewhere where they can build fairly cheaply. They're close to reliable power. And also the climate in Alberta is pretty good because, if you think you've got to cool these things down, Alberta is not a really hot area. That's not the only opportunity out there when we talk about this demand. We're really going to see a lot more opportunities coming down the pipeline when it comes to the electrical demand from these centers. We're seeing some states trying to figure out solutions. A couple data centers want to go into Seattle, and the data centers that they have planned to go into that area would use 20% of Seattle's current power usage. So just imagine Seattle's pretty much running at capacity or close to capacity. And all of a sudden they need 20% more. And where are they going to get that? So we're looking at where these projects are going to pop up, what they're going to be, because, are they going to be Capital Power, which is mostly gas generated electricity, or nuclear. We also have in the portfolio, of course, uranium, as nuclear becomes more and more of a viable solution. And the big reason why is you can put it anywhere, right? Unlike the wind or solar or any of the other alternatives, if you're moving away from fossil fuels, uranium you can put it anywhere. You put it in California, you can put it in Washington State, you can put it in the middle of the country, and you can have it close to where you're consuming it. So that's another trend that we're looking at around the electrical power needs. If you look at why this is becoming an issue, it's pretty much we haven't upgraded or increased the power outputage near the amount that we've increased our power usage over the last 20 years. Where we've really made strides over the last 20 years is efficiencies. We become, the use of power has gone down just by having, more efficient light bulbs or more efficient heat-in or more efficient, industrial uses. So we've had savings there, but we've pretty much tapped out that part of the power saving curve, and now we just need new power. And the grid, especially in the United States, is aging. There's a lot of money that has to be put into it. So trying to transmit a lot more power over the existing grid is not viable. So we need to look at ways to get power near locations where it's being consumed. So that's one of the themes I want you to keep an eye on. We're going to be talking a lot about it over the next few months as we try to identify opportunities in the portfolio. And as always, it goes back to our theme of, if we see a big surge in a certain area like AI, rather than trying to chase and trying to find who's going to be the winner there, where are the pickaxes, right? If you like gold, trying to find the right gold company might be hard, but if you find the right pickaxe seller, all the companies are going to buy the pickaxes. So we're looking at the power as a way to take advantage of the growth in power demand. And it's not just the AI wave that we're seeing out there, but globally, our society is a high reliance on electricity, and that is only growing. So that's a play that we're looking at in the portfolio, and we see that opportunity growing over time. So with that, thank you very much for watching today's video. If you made it this far, make sure you subscribe. let us know what you like, or if there's any content that you want us to cover in the future. As I mentioned, we're doing a deep dive video into the bank ETF or the covered call strategies. We talk about other strategies other than bank in there. Raj Lala, the CEO of Evolve, they've been pretty much on the cutting edge when it comes to the covered call strategies. So you want to learn more about how that works and how it can fit into your portfolio. We're also putting out a video on private debt and the dangers around that, things to be very careful of if you're thinking of investing there, or if you are in there. I really recommend you look for that video. It's going to be out in a little bit. We're just finalizing edits on that one. And if you have any of those, contact us, send in your information. Again, we're happy to do a free portfolio review for you, and give you an update on kind of where you stand or any concerns we might see in there. With that, thanks for tuning in. We love hearing from you and looking forward to talking to you again soon. Thanks very much.